Let me start with this. If beating the market was easy, everyone would be rich. Your barber would be retired, and your group chat would be full of hedge fund managers. But that's not how this works. So sit back, relax, enjoy the gameplay in the background, and let me explain why most investors fail to beat the market. Quick disclaimer before we start. Nothing in this video is financial or investment advice. This is purely for entertainment purposes and sharing personal experience. Alright, let's get into it. 1. Trying to time the market. First mistake, timing the market. Bro, trying to time the market is like trying to catch a falling phone and unlock it mid-air. You're just not built for that. I'm not built for that. Nobody is. Studies show that missing just the 10 best days in the market over a 20-year period can cut your returns by roughly half. And here's the brutal part. Those best days usually happen right after the worst days, when everyone's panicking, selling, and saying, this time it's different. So yeah, timing the market is basically speed running poverty, because you don't just need to be right once, you need to be right twice. Miss either one, you're cooked. 2. Not diversifying or betting everything on one unprofitable meme stock. Next mistake, not diversifying, or putting all your eggs in one stupid meme stock. One stock goes up 12% in a week, and suddenly you think you're Warren Buffett. Then it drops 40%, and suddenly you're a long-term investor. Here's the truth. A single stock can go to zero. An index fund? Pretty hard to kill. That's why lack of diversification is listed by major financial institutions as one of the biggest portfolio killers. Diversification isn't boring, it's protection. Don't let your portfolio look like a shrine to one company or industry. 3. Panic selling when things get spicy. Now let's talk about panic selling. Markets dip 5% and suddenly everyone becomes a doomsday prophet. I knew it. Capitalism is over. Sell everything. Research consistently shows that investors who react emotionally, especially selling during downturns, underperform the market. Why? Because they sell low, then buy back higher, or never. If your strategy changes every time the market sneezes, you're not investing, you're stress gaming, and stress gaming always loses. 4. Ignoring fees, the silent killer. Last one, fees. Everyone ignores them, until it's too late. Fees are like those expensive takeaways that were one-offs, until they became a habit. Even a 1% annual fee can reduce your long-term returns by tens of thousands over decades. And the worst part? It's the easiest mistake to avoid. Low fees equals more money staying with you. Simple maths. When we put it all together, bad timing, no diversification, emotional decisions, high fees. It makes sense. The market doesn't beat people. People beat themselves. Final thoughts. If you've made some of these mistakes, welcome to the club. Most investors don't fail because they're stupid. They fail because they're human. Stop trying to be clever. Start being consistent and safe. That's how you win long term. As always, invest smart, stay patient, and I'll catch you in the next one.